All right, great. So I'm going to get straight into it. We've scheduled an hour, and also what I've done with the presentation is, I tried to keep it reasonably short because, listen, these presentations can go on for a long period of time. We do only have an hour. We do have a follow-up session, and we can organize more follow-up sessions. So this is a very much an introduction into digital money to understand why it exists. I'm going to start right with the basics because there are a number of. I mean, the initial motivation for this session was actually the legal team trying to get some basic understanding into digital currencies, Bitcoin, cryptocurrencies. So I'm going to start right at the beginning, looking at kind of what is money, what's wrong with our money, because this provides the why as to why people are interested in these digital assets, and then getting into a little bit of the understanding of the technical aspects to these. But once again, I've kept it high level. Lots of pictures, just because I do think it's important to get our conceptual understanding rather than digging in all the detail. And as I said, if I dig into all the detail, we might be here for a few hours, and that's not the plan. So, basically what we're seeing here is a digital evolution in money. The internet has disrupted many industries, and I think it now is including money in that trend. And then I'm going to just speak through a few of the consequences and let you know about the follow-ups and the future sessions. And yeah, please do stop me if there are any questions. I'll try and take a look at the chat from time to time, but I can't promise that I will always. Okay, great. So yeah, starting right at the start is, many people obviously have a good understanding of this, but for those that don't, I think it's important to dive into this, and it's always good to refresh our memory because, to remember that money is a tool that we use every day. And so often most people have never actually thought about what is money. We just think about, receiving money, paying money, but we think about the actual tool and what purpose it, all the purposes it serves and the characteristics that it takes on. So going back with a brief history lesson, I think it's useful to note that money has been numerous different things in society throughout history. I mean, people have used all sorts of obscure objects as money. Many hundreds and thousands of years ago, people have used salt as money. People have used seashells as money. People have used cattle as money. People in North Africa have used beads as money. And these goods that people were using did serve some of the purposes of because basically what societies gravitated towards was the most tradable good in that society. Right, so in societies, salt was tradable. It was rare. It was difficult to get hands on, and people used it. It had its uses. Same thing with shells, right? If you're in certain places in the world, these shells that I've shown you a picture of here might have been, rare. But of course they've got, weaknesses. They can get old. They can chip. They're not all of the same size. So it makes it a little bit challenging for transactions. You're going to use a big one or you're going to use a small one. What if you only have a big one and then you're trying to make a smaller transaction so it's not, very divisible. And anyway, so you can get a picture of, lots of different things have been used that we tend to gravitate towards the most tradable good. And you can see how these different commodities that were used had this different weaknesses. Cattle probably did last for long periods of time, but of course the cattle does eventually pass away. It's not great at transporting over long distances unless you want to go very slowly. And so what you saw over time, societies gravitated towards metals, mining and the manufacture of metal, and eventually coinage was invented many thousands of years ago, because having coins does overcome many of the problems with these other monies. More durable, more divisible into small amounts, easier to transport, And so the society gravitated towards these metal coins, and society also tended to gravitate towards the metals that had certain properties. So societies, as they had access to these metals, they tended to gravitate towards precious metals. Because these metals were the most durable, and they were also the most rare, which implied that they held their value. So by contrast, if you're using copper as a coin, copper is very freely available. So if you're using that as your coin, then people can go and mine more copper and make the currency worth less quite easily. Whereas that's quite difficult with very rare metals like gold and silver. So it's important to note that there are reasons why society gravitated towards these different metals, and in the last 100 years, 150 years, that society started to gravitate towards paper money, because gold had certain weaknesses. It is difficult to transport gold in large quantities. So anyway, people started to gravitate towards money. But important to note that there are these characteristics of money that we don't think about every day, and I've listed those here. Right, so we want our money to be durable. We want it to be divisible, so that we can have small amounts and do smaller transactions. We want it to be portable. We want to be able to transport it. We want it to be immutable. This means that 1 rand equals 1 rand, $1 equals $1. 1 seashell does not equal 1 seashell, right? But 1 Krugerrand also equals 1 Krugerrand. So different monies are immutable, and other ones, the less better or the less high quality ones, are not immutable. And then of course we want it to be scarce. I've mentioned this. So when money is not scarce, then it doesn't hold its value particularly well. Great. And so then getting on to kind of our money, and some of the challenges that we do have with our money is that scarcity does matter, as I've mentioned. If you've got if there's no scarcity over money, then it doesn't hold its value particularly well. So here what I've shown you is that $100 and 100 rands in 1972, and then it's just been inflated by CPI inflation since that time. So what it's showing you is that that 100 rand or those $100 have lost a huge amount of value since 1972. Why? Because our monies aren't particularly scarce. So that's what I've just showed you here on this chart. If you don't understand any of the charts, just let me know. Right. So this is $100 deflated by the CPI index. So it's just showing you that today, or in the recent years, the rand is now 1.5% of its 1972 value, right? So we've lost a lot of value, the rand itself. Same thing with dollars. It's not a South African phenomenon. It's not a US phenomenon. It's a global phenomenon, and it's it's very easy to explain. The reason why is we create a lot of money, right? So this is just looking at rand. So ZAR is the South African rand. And then on the right-hand side, US dollars, and it's just a version of money supply. The money supply is the total quantity of money in South Africa for the blue, in America for the orange. And I've rebased it to 100 in 1972, so the exact numbers don't matter a lot. What matters here is the growth in the quantity of money, right? So we've created a lot of quantity of money. And of course, very important to note that there's a big difference between, the idea, many people would think, well, I want more money, right? We all want more money, but there's a big difference between what you want. So what you want is more wealth, you want more income, but there's a difference between that and the quantity of money, right? If the South African Reserve Bank suddenly increases the quantity of South African rand money tomorrow and doubles it, that doesn't make South Africa any more wealthy, right? All the goods and services and capital that we have will remain the same from the one day to the next, you'll just have twice as much money, right? So it's very important to get your head around that there's a difference between wealth, income, and then the quantity of money. Anybody have any questions on that? If you know, it can be a little bit confusing conceptually. Okay, well, please do shout, because I said these are very important conceptual points, because otherwise, you know, all the other information doesn't make as much sense. So what am I saying here? Scarcity matters on currency. If we create a lot of quantity of money, the value of the currency becomes less over time. And as you can see here, there's been a lot of quantity of rands and dollars created over time, which is why rands and dollars don't hold their value over time. Right. And now there are consequences to doing this, and often they aren't immediately apparent, right? So the one here is this loss in purchasing power of the currency. You don't, you know, always see this day to day, but over time, the loss in purchasing power is quite extreme. And then from an investment perspective, it has a big impact, right? Because, you know, if the currency holds its value. So say this 100 rand in 1972 is still worth the same amount, 100 rand, you know, 50 years later. That allows people from an investment perspective to hold some money in currency, right? Because you know it's going to hold its value. But if you know it's not going to hold its value, it forces you to take certain actions from an investment perspective, right? So what people do, instead of storing their money instead of storing their capital in actual South African rands or US dollars, people invest their money into assets, right? So here, all I've shown you here is it's the blue line is the all share index, also deflated by the CPI. So it's the real all share index, right? And then I've shown you the real bond index, which is the orange line. And then once again, the red line is the purchasing power of the rand, which I've shown you on the previous charts. So obviously that one is going down because rand's lost its value, which has forced people into holding financial assets, right? Because they can't hold value in cash because that's losing value, right? And so that's kind of what, you know, a lot of what goes on in investment markets is that people are trying to make sure that they beat inflation. And of course, as you see, you know, financial assets like the all share index, South African equity have, you know, served that purpose reasonably well. But then once again, there are other follow-on consequences to this, right? Because for the people who hold these assets, it's a good experience to have the assets go up in price, right? So if you hold equities and you hold bonds, it's good if the assets go up in price, if they receive all of this new money. But now if you don't hold the assets, then it becomes a slightly more challenging situation because you know, everybody wants to save for their future. So if you're a young person, or if you're a person who just didn't previously have a lot of wealth in 2021, and you're now trying to save for your future, what you'll find is that, you know, equities and property, these financial assets, they're expensive to buy because everybody else has already, you know, purchased them with all of this, you know, money that has been created. And the consequence of that is you actually see quite a lot of inequality in the world. So it creates unequal consequences, all of this money creation. It puts wealth in the hands of the few relative to the many. And this is once again a consequence that it's difficult to see on a daily basis, but it makes complete sense, right? If you think, once again, if you just make an extreme example, you know, if interest rates in the economy fall from, you know, 10% to 5%, who are the people who access that new money, right? Well, there's nothing nefarious about it, but there's certain people that have access to private bankers, who have access to corporate lines of credit, Well, it's, bigger businesses, it's richer people, it's wealthier people. It's nothing, nefarious about it. That's just the way the mechanism works. That these people have access to that cheap money far more easily than everybody else. And so you start to see these unequal consequences in society. Here I've just shown you a chart from the US. So it's the S&P 500, which is the US equity market index, the price of it, and then how many hours the average American would take to buy the S&P 500. Right, so it's just the price of the index denominated by average hourly earnings. And what it shows you is that it takes a long time for Americans now to buy the S&P 500, particularly compared to history, when it didn't take nearly as many hours. Historically, between 1965 and 1995, it took Americans, around 10 to 40 hours to buy a piece of the S&P 500. And now, today, it takes 150 hours, right? So, more than 3 times as long. So there's a very unequal impact. And just to reiterate the point, this is great if you hold the asset, right? So my dad, he's an older guy, he saved for his retirement, he holds property, he holds equity. I've got nothing against my dad, but he's the type of person that would have held these assets, and he had a good experience with that. But now, other people trying to buy these assets, it's a little bit more challenging. So I hope you see one of the consequences here, the social consequences, the investment consequences of this money, right, that doesn't hold its value. So it just gives you a little of a picture of what some of the things that are wrong with our money, right? It's not scarce, it doesn't hold its value. It has these financial implications of, where do we then end up storing our value? It has impacts on the investment process, and it has unequal consequences in terms of societal outcomes and many others. So I've kept the presentation, as I said, reasonably punchy because we've just got an hour allocated here. So I'm just making sure I do keep an eye on the time. All right, but amongst others, there are other consequences. Okay, so once again, just shout if there are any questions. We're happy to take questions at any time. Okay, so getting onto the Bitcoin cryptocurrency digital asset side of the presentation, we are a third of the way through. So basically, this started in 2008 when Satoshi Nakamoto, who is a pseudonymous person, we don't know if it's a man, a woman, a group of people, released this idea onto a mailing list, and then the actual process, advent of Bitcoin actually started in 2009, but released this white paper onto this mailing list, and eventually actually saw a creation of the currency in 2009. Right, so as I said, I don't want to get into every last detail of how it works, but I'm going to provide a few so that you can get your head around it and relate it to the previous sections in the presentation. So I think the first point to note is that it is important to bear in mind that it was actually a long time coming. This is just a quote from an old economist who's now passed away, Milton Friedman, a very famous economist. Talking in 1999 about the internet and how it's a major force for reducing the role of government. But the one thing that's missing that will soon be developed is a reliable kind of e-cash. So he'd seen the power of the internet, but thought that an electronic version of cash would be developed at some point in the future. And innovators have been working on a digital cash for many years, even before this, from the start of the internet. There are all sorts of examples, things like DigiCash and eCash, these were all attempts by people to solve this idea of having a cash that is entirely native to the internet. So I mean, the advent of Bitcoin wasn't just some kind of piece of magic that happened at a point in time. People had been working on this concept for a long period of time. And getting on to a little bit of how it works. So maybe as an example, right? And comparing centralized money to basically what Bitcoin is a digital, decentralized network money. And then obviously comparing that to what we have, which is centralized money. So if I want to do a financial transaction, if I want to send some money, I'm going to say to Alex, I was just chatting to Alex, I know he's on the call. If I want to send some money to Alex now, so I can log onto my phone and I can send Alex 100 Rand. But the way that transaction works is I log onto my banking app, I send an instruction to the bank, and then that bank sends the money to Alex. That's if, of course, we use the same bank. If it's not the same bank, so I bank with FNB, let's say Alex is with Standard Bank, then the instruction will go from me to FNB, from FNB to Standard Bank, and from Standard Bank to Alex, right? So, I mean, the banks are all interconnected, so they will, effectively show the change in the balance from me to Alex pretty quickly. But the actual settlement of that information takes a few days, because behind the scenes, the banks have to do reconciliation of the process, right? They got to sit that down to themselves. They say, okay, does Rob actually have the money in his account? Okay, yes, he does. Okay, where does Alex bank with? Where's this money going to? Oh, okay, it's going to Standard Bank. Okay, send it on to Standard Bank. Then they have to clear it between the banks, and then it goes to Alex's account. So while it shows that it's settled in the account, behind the scenes, the technology is quite different. It's a little bit old-fashioned, actually, because it requires this actual centralized reconciliation of the information, right? So what a digital money involves is that it's entirely peer-to-peer. So if I want to send 100 Rand to Alex via digital money or via Bitcoin, what happens is that I can send the money directly from myself to Alex via the internet, right? And this is actually quite a revolutionary thing, right? Because it's a structural change that you no longer need to send it through a centralized intermediary. Another way to think about the magnitude of this invention is to realize that before Bitcoin, digital scarcity never existed. So if I want to take a screenshot of all the people on this call at the moment, I can take a screenshot and then I can send it all to you. I can send it to 100 people, 1,000 people, 1,000,000 people, no problem, right? You can replicate a piece of digital information. And you guys are quite, well aware that, companies like Microsoft, they create this software, but it's quite easy for people to actually replicate these things. They try and create all these keys and they send you the key, but in actual fact, people, tech people can get through these security processes very easily, because it's digital scarcity in reality didn't exist. With Bitcoin, you can't create another Bitcoin very easily. We've actually had it's the advent of digital scarcity. So just kind of pull back the lens there and just think about to yourself, okay, so before Bitcoin, there was no digital scarcity. We had the internet, which had all these, big impacts on society, but we've never actually had scarcity on the internet. And now we've actually got an asset that is digitally native to the internet and it's scarce. So it's quite an incredible innovation. And as I said, I'm not going to get into every last detail, technically how it works, because I think for now we'll stick to the introduction, but just, you know, one piece of insight, because, you know, often there are questions around this, is so how? Okay, so how does that work? Well, essentially, you know, what Bitcoin is it's a combination of a few different technologies, right? So I'm obviously taking a few different angles to give you an idea into those few different components. But the one component is basically a digital ledger. You could imagine like even like an Excel doc online, right? Where we all keep the balances. Sorry, 1 second. Just hearing my alarm go off, which is been a big distraction. All right, so you can imagine like a Google Doc, like an Excel doc online, right? Where we could all keep the balances of all our money on that document, right? Now, you can imagine that existing, right? So we have this big, you know, complicated spreadsheet, which is just a ledger of all our balances on the internet. And we could all kind of send our transactions there, and it could be kept on this, you know, one database. We can all have our different copies of the database on our you know, computers or phones or whatever to see the amounts, right? But of course so you can imagine that working. But the weakness there, of course, is that you know, how can I stop, you know, nefarious actors? What if I say that I send 100 Rand, you know, to Alex, but what if I just, you know, put another entry onto that document and I say that I, you know, send it to somebody else. I send it to non-clunkler on the, you know, 10 minutes later, right? So then I would be cheating the system. So the way that, you know, Bitcoin gets around that is that there are certain people who are allowed to execute the transactions on the network, right? And in order for them to execute those transactions, they have to prove that they've done, well, not just prove, they've got to do a lot of work. So it's not easy for them to add new transactions. They actually have to use these big computers and lots of electricity to process those transactions. And once they've processed the transactions, us as people on the network can quite easily see whether they've done it correctly or not, right? And if they've done it incorrectly, then all of their work becomes a waste of time. So because they've processed these transactions, they've tried to cheat. So they've tried to send the money to different people that what didn't make sense. And us as participants can quickly go and look at what they've done and say, you guys have made you've made an error. You've tried to cheat the network. And then so instead of believing what you've done, we're going to believe what somebody's done who's done it accurately, right? So essentially that creates the incentive structure for these validators of the transactions to do it properly. And that really is actually the big invention of Bitcoin, right? The idea of a digital ledger existed a long time before. The idea of digital money existed for a long time before. But what Satoshi Nakamoto, they managed to achieve was this additional innovation to be able to handle nefarious actors and incentivize even nefarious actors to act honestly on this network, even though we don't know who they are, right? So that's proof of work in a very summarized version. So these people have to do a lot of work, and it's expensive, it takes time, and they want to get rewarded for doing that work. And just out of interest, the way that they get rewarded is by earning fees and getting new Bitcoin supply. Okay, so that's just, that's about as technical as I'm going to get. Okay, but to summarize, what have we got here, right? This digital evolution in money by the invention of Bitcoin, a peer-to-peer electronic cash system, a long time coming. It's decentralized peer-to-peer money as opposed to centralized money, which is the advent of digital scarcity, which is a pretty incredible innovation. And the way that it does that is through this technique called proof of work, which incentivizes bad actors to even act honestly on the network. And then importantly, Bitcoin has scarcity, right? So just what I'm showing here on the graph, it's nothing complex. The Bitcoin, there will only be 21 million Bitcoins ever, right? So that's what I'm showing you there on the orange line. It's the Bitcoins in circulation up to today. So we're at about, between 18.5 million and 19 million of the Bitcoins have already been mined, have already been created. And you can see how it's kind of asymptotically approaching a level. That level is 21 million. So there'll only ever be 21 million Bitcoins. And then the blue line is just the growth in Bitcoins. So of course, when it started, there were lots of Bitcoins being created. And just once again, a little technical attribute of why that line is falling is because the way that Bitcoin supply gets created is when the miners put new transactions into a block and add it to the blockchain. That's where the word blockchain comes from. Because what the miners do is they bucket all these transactions, they put them together, and then every 10 minutes they add a new block of transactions onto the blockchain, right? And they get rewarded with new Bitcoin supply. And when Bitcoin first started, they got rewarded with 50 Bitcoins every 10 minutes. And then 4 years later, the supply dropped in half from 50 to 25. 4 years later, it dropped from 25 to 12.5. So every 4 years, the supply that gets created every 10 minutes gets cut in half. And important to note, this is all pre-programmed into the protocol. So nobody is, there's no kind of monetary policy committee overseeing how many Bitcoins will come into circulation over the coming months or quarters or years. It's all predetermined when Satoshi Nakamoto released the white paper and created Bitcoin. So that's why we know with certainty exactly what the Bitcoin supply is going to be in the future. And as relating this now to the previous presentation, so now we've got this money that is not only digital and peer-to-peer, but it is scarce. So it has these innovations and improvements on top of our current money. All right, so what is the outcome here of what I'm calling quite a revolutionary technology? I would say, if I was going to describe to people what Bitcoin is in kind of a couple of minutes, this is what I would focus on. So I've kind of taken you through the thought process, but this is really, I guess, the conclusion is that it's a digital store of value. And so store of value is an asset that holds its value over long periods of time. And the reason why it stores value is because it's scarce, as I've shown you on the previous slide. Just checking on any questions here. Said you shout if there are any questions. It's because it's scarce, right? That's why it holds its value. And just to kind of prove the point, right? I mean, Bitcoin is very volatile, no doubt, but it does hold its value over long periods of time. So here is just, Bitcoin's rolling 3-year change in the price. And you can see that, it hardly is ever negative, right? Over periods longer than 3 years, Bitcoin's price tends to increase. As I said, very volatile. This is not an investment presentation, but I'm just proving to you the point that it does store value over periods longer than 3 years, right? So 3 kind of things that Bitcoin is. 1, a store of value, an asset where it does actually hold its value over longer periods of time. 2, it is a digital payments network, right? I can log onto my phone and I can send people money over the internet to anyone, anywhere in 10 to 30 minutes, right? So, I mean, the first block that if I send a transaction, it'll get included in a block, and then in the next 10 minutes, and after it's been included in a couple of blocks, I can be 100% certain that is accurate. Just in case there was some some silly miner who tried to do something incorrectly in the next 10 minutes, then people would figure that out and everything would kind of get into place within 30 minutes. But the point here is less related to that. It's more the fact that I can send money to anyone, anywhere in the world, as long as they're on the Bitcoin network, in 10 to 30 minutes. So if I want to send money to somebody in China, no problem. Same as sending it to somebody in South Africa, sending it to non-clientele, sending it to somebody in South America. It's a digital payments network that allows anyone anywhere to access it. And then lastly, it's potentially even more than that, right? Because you're transferring value independent of judicial, banking, or regulatory authorities, which is quite a powerful idea, right? There's no intermediary here determining who owns which Bitcoin and who doesn't own which Bitcoin. It's all determined by the protocol itself. So it's in fact an independent system of property rights, which is quite powerful. And it's important that this system itself has never been hacked. So you do see certain companies in Bitcoin being hacked, just like all sorts of companies can be hacked. If a whole bunch of Bitcoin are sitting in a company, people in that company could steal the money and send it to themselves, or hackers could hack into that company and steal the Bitcoin. But that's hacking the company. It's not actually hacking the Bitcoin protocol or the Bitcoin blockchain, which is almost never been hacked. It's very difficult to hack a Bitcoin wallet. It's near impossible. And just taking what I said here one step further forward, it may be just to provide you with a brief example. So who are these things useful for? Well, a digital store of value is useful for people whose currencies lose value. Now, of course, every country is on a spectrum. A place like Zimbabwe, of course, their currency lost extreme value over a short period of time, and Zimbabweans would have loved to have their hands on Bitcoin, and many of them did use assets like gold. But I mean, it would be easier for them to get their hands on Bitcoin than it would be on gold. And many Zimbabweans who experienced hyperinflation have an affinity to something like Bitcoin because they understand its value. But as I said, every country is on a spectrum. I mean, Zimbabwe is the extreme case scenario. I've showed you that even the rand, while of course the rand does not experience hyperinflation whatsoever, it has lost its value over time. So there's very few countries and currencies in the world where the currencies actually hold value. So a lot of people see value in an asset that doesn't lose its value. And as a digital payments network, well, it's very useful for cross-border payments. There's lots of people who send remittances to their family back home. People in America might send remittances to their family in Mexico or in South America. People in South Africa might send remittances. Potentially they've got family in the rest of Africa, right? And these payments, as I've mentioned, they can take time, and they're quite costly. With Bitcoin, it doesn't take a lot of time, 10 to 30 minutes to get full and final settlement of the transaction. And there's no borders in Bitcoin. It's entirely native to the internet. So that can be very effective for cross-border payments. And then the last one, who's this useful for? Well, it's useful for people who are restricted from their financial system, which are actually many people around the world. I was reading recently an example of women in Afghanistan. Because of the laws in Afghanistan, women aren't allowed to open bank accounts. So it restricts their ability to act commercially. But with Bitcoin, they can open up a Bitcoin account and earn Bitcoin. So it's been quite empowering for these people. So that just gives you an example of this, revolutionary technology, what it is, what it does, and who it's useful for. And obviously, there's a broad range of different people on this list, which I appreciate, I guess, can be confusing, but hopefully you can kind of digest each one individually. And I think this is actually a remarkable achievement. I mean, the more I think about Bitcoin, the more remarkable it is, really. I think that it's potentially equivalent to the invention of many other profound technologies, things like domesticated crops, the steam engine, the spinning wheel, the printing press, the telephone, the airplane, or the internet. These things profoundly changed the world that we live in. And they changed the world in many different ways. You know, if you think about the printing press, I mean, the printing press, basically, I mean, the Roman Catholic Church had a lot of kind of control over Europe during the time, and the printing press kind of broke their monopoly on the word of God, and also had all of these additional consequences on government, on commerce, that people would not have seen to start with. The steam engine was initially invented to harness power in factories, but eventually was used on railroads and steam engines, allowing people to transport goods, and even fostered migration of human people. So what I'm saying there is the consequences and the ramifications of these foundational technologies can be further than we can even see. So, I've and on many different areas of kind of economics, social life, commerce. So it's no surprise that I've given kind of these, quite varied examples here, and potentially there are a number more to come. And it's important to note that there are, of course, there are winners and losers to any change, right? So all of these technological inventions that took place in the past had people who didn't like them, right? So if you were, let's go to the steam engine, right? The steam engine took a lot of power away from horse-drawn carriages and horsepower. So if you were a person who bred horses or sold horses or built carriages, all these type of things, that would have been a lot of pressure on you. And the people wouldn't have liked it. This is just a picture of the Luddites in the Industrial Revolution breaking, technology because it wasn't something that they liked. But there are always going to be people who are disrupted by changes in technology and don't like it. And there are also just going to be people who are resistant to change. I mean, we as humans, we don't like dramatic changes. It's uncomfortable. It causes us to really have to think differently about things, and that can be a challenge. And listen, I'm sympathetic to that. But the truth is that just because that there are detractors to technology, doesn't imply that they are not a good idea. We saw detractors to all technologies. Technological kind of revolutions in the past, and we will see ones during this revolution too. And I mean, it's important to note as well. I mean, people often will call Bitcoin as a fad, but fads don't rise from the dead, right? So Bitcoin has been declared dead many times in the past because the price has dropped. The price has dropped as much as 95% over periods of time. But remember, this is it started out as a nascent technology used by a handful of people, and the price of Bitcoin was basically zero at one point. It didn't have a price until many months and quarters later. But yes, the price has dropped dramatically in the past. But it is always the network has always continued to work, and in fact, the price is almost somewhat irrelevant to the network itself. There's no actual price on the network. The price is just people external to the network valuing how they perceive that network. And remember, I mean, humans are prone to emotion, to emotional interpretations of what they're seeing. They're prone to exuberance and fear as well on the other side. And it's not an easy asset to value. As I said, this is not an investment presentation. I might give a more detailed investment presentation to the investment team, but they'll know very well that it's not a very easy asset to value Bitcoin. and so people are prone to thinking that it's this, to overestimating its importance and then underestimating its importance. But the fact is that it's continued to run, it's continued to process transactions, and despite the fact that it's been declared dead so many times before, it continues to exist. So I like this quote from Andreas Antonopoulos. He talks about Bitcoin. A lot of people will think about Bitcoin as internet money, which is not incorrect, but it's actually more than that, right? It's not just money for the internet. It's the internet of money. So the way that the internet came along and disrupted so many different industries, if you think about it, I'm sure there are some older people on the call. I hope so. If you think back, 30, 40 years ago, the post office was a very important institution in society, used to deliver information. But now the post office is not an important institution. The internet has come along and disrupted and decentralized information. So, the same way that the internet disrupted and decentralized information, that is what Bitcoin is doing to money, the money industry. It's disrupting and decentralizing this industry. And it's important to note, since the internet came along and it disrupted and decentralized a number of industries and led to the creation of a number of powerful networks that became powerful very quickly. If you can think about Apple as the electronics network, you can think about Amazon as the shopping network, you can think about Google as the internet network, and you can think about Facebook as a social network. And these organizations accrued significant value in quite a short period of time. If you look back, Amazon was worth, almost not nothing, but it was worth a fraction of what it's worth today, 20 years ago, and it didn't exist 30 years ago. And today, it's a ginormous company, because the internet is got powerful network effects, right? So once you get a foothold and you get users and you get scale, it's very difficult to topple these technological giants. And what you're starting to see here is that Bitcoin is competing in size. It's not actually competing with these other networks. It's maybe I'm just comparing the size of Bitcoin to other digital networks. And what I've just shown you here is the market capitalization of those networks and of Bitcoin's network. Market capitalization is a very crude measure. It's not necessarily perfectly valuing Apple or Amazon or Google or Facebook or Bitcoin, but it just gives you an indication of the size of those networks and the size that Bitcoin has grown to. I would also add that, of course, money and the financial network is potentially in orders of magnitude more important than electronics and shopping and internet. But as I said, this is not an investment presentation. I'm just getting your head conceptually around this technology. All right, so I'm wrapping it up. We're into the last 10 minutes. Okay, so what are the consequences here, right? Both challenges and opportunities, right? So I think, the first point is coming all the way to the start. I said that, I think that Bitcoin allows people to really appreciate what money is and ask deeper questions about it that were very rarely asked, outside of kind of, economics at university. And now asking people, people are starting to understand the consequences of our current money, because, previously, once again, people didn't think about it a lot because there weren't many alternatives. And I think a technological revolution could very well be underway. We'll only know that in hindsight, but the way that I reflect on this technology, I think it will have profound implications on society and commerce. And what we are seeing develop here is a new asset class, new businesses which service that asset class, entirely new businesses, new exchanges, new types of investors, and then it's also changing industries. So I mean, certain industries now are changing their technology to be able to account for this new technology, which you need to plug into it. It doesn't just automatically happen. You have to change certain things with your payments network in order to plug into these new digital networks, and potentially it creates a new financial system. And in a sense, I guess that already is the case. The Bitcoin network is its own financial system, which is not reliant on the current financial system. And there are numerous innovations, of course, taking place. I said I've kept this as an intro, but the innovation of Bitcoin as a technology is now being used in different ways by different other organizations, creating all sorts of other consequences. People are now creating decentralized exchanges on the internet, and tokenization of digital assets, which I'm not going to get into, but just giving you an idea that there are these other implications and innovations. And this disruptive technology is particularly disruptive for centralized institutions in different ways or shapes or forms. But for banks, for central banks, for regulators, for exchanges, clearinghouses, custodians, and many other businesses. And say that these entities won't exist. That's not what I'm saying. I'm just saying that it is disruptive. It puts a lot of pressure on these institutions. Maybe not today, but increasingly over time, it is putting pressure as the network grows, right? Because 5 years ago, Bitcoin was a lot smaller, and now Bitcoin is almost a $1 trillion market cap. As it grows, it takes more value away from these other institutions, and it puts pressure on them. So basically, I think that the question is out there for individuals, for businesses, for institutions, for regulators to adapt or regress, because this technology is kind of out of the bag. I don't think it's going to be very easy to put it back in the bag. I'm going to pause here because our time is up. I can take more questions. Well, I can take questions in general, and we can go on to a few more slides, but I am going to pause there. And I also just said here is that we have obviously planned for forthcoming sessions. So the next one, particularly with the legal team, we're of course going into legal and regulation around Bitcoin. Can governments ban Bitcoin? What is the situation, the SA context? And then from the investment team perspective, going into investing in Bitcoin, so understanding it as an asset class, the volatility portfolio positioning. And then we can also go more into detail into how this thing works, mining fees, proof of work. But I'm happy to take any questions on these, but that has taken us almost exactly to the hour. So I will pause there and see if there are any questions.
Thanks, Rob. I'm just waiting for questions for you. Doesn't seem to be any questions at the moment. But thanks. I think it was a good session to give us an introduction to what Bitcoin cryptocurrency is. And we look forward to the upcoming sessions that we'll keep scheduling.
Yes, exactly. Yeah, I think we've got one next Thursday, a little bit later in the afternoon. But yeah, please, guys, don't be shy to ask questions. There's no stupid questions. There's no silly questions. There's no questions that are too simple. I really do find that you got to ask questions and grapple with these ideas to get one's head around them. So I really do encourage you to ask questions and not hold back.
Rob, sorry, just one question from our side, maybe just for the next session, in terms of what stops Bitcoin being replicated? You know what I mean? Like to create a carbon copy that will basically, yes, okay, you've got a limited scarce resource, but if there's a carbon copy, there's going to be, let's call it, wake up additional appetite, and it's just going to be swing from one currency to another cryptocurrency. What can prevent that?
Completely. It's a great question. And as I said, I haven't included that detail on this presentation. In fact, I put up here a number of Bitcoin criticisms. So I've given you a list here to choose from that you can fire away if you like. But yeah, replication is number 5 here on the list. So yeah, you're right, Alex. So Bitcoin is just code, right? So you can just take that code and create another Bitcoin. And in fact, many of the other cryptocurrencies are exactly that. So people took Bitcoin, they made a slight change, and they created a new cryptocurrency. So there's another cryptocurrency called Litecoin. That's a replication of Bitcoin with a slight change. But important to note, for a digital network to be valuable, it has to have network effects, right? So, so I'm just getting this off my screen. It has to have network effects. So people have to, it's useful that you can log onto Bitcoin, and that because it's the biggest cryptocurrency, I know that it's much more likely that people will sell me it and buy it from me, right? So it has that network effect in terms of its usability, its tradability, right? Whereas a smaller cryptocurrency has many less network effects, right? Because many fewer people are using it, right? So that's just one component. But then over and above that, the size of a digital network also has impact on its security. It's not just its ease of tradability. So, Bitcoin, as I've mentioned, is secured by miners who allocate their computers and electricity to the network in order to secure it. And so because Bitcoin is the biggest network, it has got the most miners, and it's got the most hashing power, as we call it. Hashing power is just computer processing power. It's got the most computer processing power securing and verifying the transactions, which actually implies that it is the safest network because it's got the most security. So when a new user comes along and says, okay, well, what am I going to use here? Am I going to buy Bitcoin or am I going to buy another asset? The argument is it's actually more simple than people think, because you should choose the one that is the most secure, which is Bitcoin. If you're going to the other ones, it's not to say that there aren't great innovations taking place there, but you are going to a network that is inherently less secure and more speculative. And then similarly, that's somebody who's looking to buy Bitcoin. What if you have computers and you're saying, okay, I want to contribute to these towards the network? But a similar argument applies. The miners will think to themselves, okay, well, which network am I most clear about what I'm going to earn? Well, with Bitcoin, you have the most certainty that the protocol will remain intact because the protocol has existed for the longest period of time. And then you also know that what you're earning, once again, is part of the most secure network. So there's a lot of incentives which keep people locked into Bitcoin. I haven't put up the chart here, but what you'll see is that Bitcoin continues to be, more than 60% of the cryptocurrency market cap. And in fact, as I've mentioned, market cap is not even potentially the best measure, but it shows you that it still dominates. That's not to say that it could never be usurped. I'm not dogmatic about this. It could be usurped, but I hope you can see why I think it's unlikely, because it has these network effects. And coming back to a real world example, think about it. Do you think, Amazon is going to be usurped? Listen, it's possible, but it's very difficult for people to compete with the network effects created by these other digital networks. So yeah, Bitcoin's got a lot of lock in there. So yes, you can replicate the code, but you can't replicate the network effects.
Perfect. Thanks, Rob.
Sorry, Rob, I saw Louis actually had his hand up earlier in your presentation. Louis, would you like to ask your question now, or was it answered in the presentation?
Rob, no, that was just, I think he has answered it. In fact, it's probably more like a criticism that's leveled against Bitcoin on the issue of scarcity, the fact that, look, whether I like it or not, I mean, he will understand it better than myself. He's an economist, that scarcity has got to do with usage of an asset. So the more it becomes mainstream, there's a view that maybe perhaps the price will maybe find its natural, level or value. Not so, certainly not as the prices that we've seen, especially in the recent past.
Yes, I think what you're pointing to there, Louis, is that the volatility, and I did speak briefly about it, but as I said, I didn't focus on it because this wasn't a specifically investment presentation. But I mean, listen, Bitcoin is volatile. There's no denying that. As I've shown you, it is positive over long periods of time, so it does function as a store of value, but it is a volatile store of value, no doubt. And I think, as I mentioned, the reason for it is because this is a powerful technology, but humans are interacting with it, and humans humans can do all sorts of crazy things in how we interact with an asset. I mean, you can even see that in the traditional financial markets. I mean, I know a lot of people on the call aren't investment professionals, but there are all sorts of crazy things that happen in traditional financial markets. People speculating on Tesla stock. It's got it's overvalued many orders of magnitude higher than what would be normal. Anyway, but I'm just making the point there that humans can do all sorts of strange things in how they interact with an asset. And you're seeing the same thing with Bitcoin. There are times when people get over exuberant and they buy Bitcoin either because they actually do believe that there's something very exciting going on there, but often people are just buying because the price has gone up. Right, and that's what's happening in 2021. And in fact, you're going to see more of that in 2021, is that people get interested in Bitcoin just because the price has gone up. Now, that's not a good reason to get interested. You should really look at the underlying technology, but it is what it is. I mean, we can't stop people doing what they do. So they buy something because the price has gone up. They don't understand what it is that they've bought. And then because of that, if the price goes down, they can just as easily sell. And that, of course, contributes towards this volatility. And as I said, so I think that the volatility still will exist for a period of time, but I agree with you, over longer periods of time, as there's greater adoption of this asset, then the volatility will start to reduce substantially, right? If everybody holds Bitcoin, then people are no longer grappling with whether it's a good idea or not. They've all kind of decided it is a good idea. And so then they're not going to be buying and selling the thing, back and forth on a day-to-day basis. But we have to be aware that the volatility does exist, and anybody who's actually thinking about investing in the asset needs to understand these different components. They need to be comfortable with the volatility, and most importantly, they need to be thinking about holding it for a long period of time and not caring about the volatility. If you, as I've shown you, if you hold it over long periods of time, the volatility starts to become irrelevant.
Thanks, Rob. Appreciate that.
Fantastic. Any other questions? I've got time for one more question. Don't feel shy, really. Any stupid questions? The stupid questions are not stupid. The simple, the basic. Any question is a good question, but the most basic questions often provide the most revealing information. So I really do encourage you to shoot.
Rob, sorry, last question from my side. On your point on that waste energy, since maybe it's a South African question because we're sitting with no power at the moment.
Yeah.
But with institutional market players maybe increasing participation on the investment component, do you think, and ESG being the theme at the moment, do you think this is going to be potentially become moved up from the, let's call it, from the number 4 to number 1 in terms of from criticism perspective? Or do you think it's going to be, or can it, I presume it's that wastage energy is not going to be improving. It's just going to get, the consumption is going to get greater as you're going to get to that 21 million, I presume that count of the Bitcoins, am I right? Or does it stay the same in terms of the energy consumption of those transactions?
Yeah, so good question. So basically what Alex is getting at here, right? So I mean, I have mentioned in the presentation, but miners who verify the network, validate the transactions, and they get rewarded with new Bitcoin supply, they contribute their computers, these specialized computers, and electricity. And what they do is difficult and it's quite complex, and they use a fair amount of electricity. And because the Bitcoin network is entirely online and it's observable, you can estimate how much electricity is being used, which is very unlike most other industries, right? You can't estimate how much electricity is being used by the banks in Joburg or the banks in the world. This is a very difficult calculation to make. But with Bitcoin, because the information is all obvious online, you can estimate how much electricity is being used. And there is quite a lot of electricity being used. Now, this leads some people to think, oh, well, this is a lot of energy. You guys are wasting energy. But I think what they're doing is they're missing a little bit of information below the surface. So first of all, as I've mentioned, in other industries, you cannot estimate how much energy is being used. So you compare properly, let's say, Bitcoin continues to be successful, that will reduce the need for having, as many banks, as many central banks, as many financial institutions, it could be a more efficient use of energy relative to all the energy that we have, in bank branches, bank offices, all these regulators around the world. So it could be much more efficient actually using Bitcoin by comparison. So we aren't able to do that comparison perfectly because the information isn't available. And then a very interesting technical component to understanding Bitcoin mining is because it's a very competitive industry, right? So all these guys want is good equipment and cheap electricity. And the miners come in a box like this. So you can actually transport them anywhere in the world reasonably easily. And so what happens is that these miners gravitate towards the cheapest electricity, and the cheapest electricity is actually wasted electricity. The world wastes a lot of electricity because the electricity problem is not only one of generation, but it's of getting it to somewhere at the right time. So that transportation of electricity is actually quite challenging. And then, as I said, using it at the right time. So what Bitcoin miners will do is they will go towards places where electricity is basically being wasted. So, in China, they have a lot of like hydroelectric dams where they don't use all of electricity because it's not being created at the right time, or they've got surplus. And so these miners are actually using electricity which was going to be wasted anyway. And they are able to create Bitcoin through that. So yes, they are using a lot of electricity, but the electricity was actually going to be wasted. Now, whenever electricity is expensive, like in South Africa, electricity should be more expensive than it is if it was priced appropriately. But of course, it has gone up in recent years, and it's no longer economical to mine Bitcoin in South Africa. So there isn't much Bitcoin mining in South Africa. Bitcoin miners have gravitated towards other places. So hopefully you can see through my examples that yes, Bitcoin mining does use a lot of electricity, but that disguises a lot of detail below the surface, that you can't actually compare Bitcoin properly to other industries. Bitcoin could be more efficient. I think it is a lot more efficient. And then secondly, the miners are actually using a lot of wasted electricity. The other example of wasted electricity is you see a lot of wasted electricity on oil wells in North America, where they're creating a lot of like flare gas. And a lot of these oil wells will burn up the gas because it's better for the environment than just letting the gas go out into the environment. So they burn it up. And now what these innovative guys in Bitcoin mining have done is taken miners to these oil wells, installed them, so they can at least use that gas to earn Bitcoin rather than just burning it for just for the sake of it. So it's actually solving energy problems, which is pretty incredible.
Perfect. Thanks, Rob.
Okay, well, I need to drop off the call shortly, so I think let's call it there. You're welcome to send through any questions via email. I really do encourage you to do so. Looking forward to next week, Thursday. As I said, we're going to go more into the legal side. Can governments ban regulation? Can governments ban Bitcoin? The legal regulation and the SA context. And yeah, please do send through your questions, and also bring your questions to the session. Enjoy your evening.
Thanks, Rob. All the best. Thank you, everybody.
Bye-bye. Oh, and apologies again about Monday, and thanks for coming through today.
Thank you very much.
I do apologize for that. Thank you. Bye.
Okay, thanks. Bye.
Bye.